Welcome to the Friday Gold Wrap. This is Peter Schiff. Since I'm still relatively new to wrap, I completely neglected to do last week's Friday wrap. I completely forgot about it last week because I haven't been doing it for very long, but this week I couldn't let it slip my mind. Certainly, the mining stocks and the precious metals had a successful week before to this one. This week, though, was the icing on the cake. Earlier afternoon, gold finally reached a new record high. I believe this was the first time we ever traded above 3,450. I believe we were slightly below that level and not quite above it, while gold enjoyed a fantastic week. Over 2.5%, it was up roughly 2.1%. Next week, silver performed much better. A new record high was not achieved, but a new high of 13 years was. Almost $40 an ounce was the price of silver. It was probably within a nickel of 49 at the most. Around 39.80 was the closing price. The precise details elude me. I really doubt that they have resolved it just yet. Following foreign, I will be recording this podcast. Those things are still traded. Oh, I see. It's a record high for the past 13 years. Great. This is a perfect way to conclude the week and start the day before a vacation weekend. On Friday, we will be off for the Labor Day vacation. The price of gold and silver in particular are likely to spike. When American investors return to the markets on Tuesday, I predict a significant gap increase in prices, with silver opening above $40 per ounce and gold above $3,500 per ounce. Time will tell. As I indicated in my podcast 2 weeks ago, the gold stocks are still at the top. Investors who were utterly pessimistic about the gold bull and thought it would soon die aren't dragging them behind as they were. All eyes are on the gold stocks now. During the same time period that gold stocks were up 20%, gold itself was down roughly 2% as of this week, I believe. As gold mining stocks caught up, the precious metal was simply consolidating. Because of this, I was banging on the table in April and May of this year about how the best spot to purchase gold was in the ground when the stocks hadn't even moved. Already things are heating up, with the major gold mining equities GDX already up more than 87% year to date. It looks like this year will be the best one yet. So, I suppose this index wouldn't have been around in the 1970s if you traveled back in time that far. We are still in the midst of what has been the most successful year for this ETF to date. I mean, collectively, I expect gold stocks to more than double in value. Now, I know that some of these stocks will perform much better than that, but we're talking about a market that's up 87%, 84%, 86% right now. The junior group, known as GDXJ, has increased by more than 87% year to date. This means that these equities are reacting strongly. Gold has gained 32% so far this year. A remarkable year has been had by gold. Increase of 38% for silver. Well, I believe we're going to head straight for 50 after we gain 40. And once we hit 50, will Katie shut the door? Accordingly, dally no more. My podcast and X feed have been absolutely bombastic recently. The folks at Shift Gold need to pick up the phone and call their clients. They need to buy more silver and gold, I've been telling them. Clients have been hesitant to buy, according to the feedback I've been receiving, since they are afraid of buying at the peak and would rather wait for a drop. Remember, I said before that you shouldn't wait for setbacks. No substantial setbacks are in your future. The only thing you need to do is purchase. Buying the highs is a given. In fact, it's a necessary condition for buying. The worst part is that the highs will only go up from here. So the higher the price you'll pay, the longer you have to wait. Make haste. When silver initially rose beyond $30 per ounce, I remember saying things like 30 is the new floor, comparing it to $2,000 for gold. When gold hit $2,000, I warned people not to buy it because they assumed that was the high. No, the new floor is 2,000, I corrected. If you buy 2,210, you're essentially purchasing at the bottom. Many were terrified that it was the peak. Today is a new day, I kept repeating. A large bull market is underway. Purchasing this level is essential. Indeed, we are about 3,500. We are aiming far higher. The same holds true with silver. Gold was $31.32. Everyone should get it, I kept saying. By the time it drops below 30, it will have dropped quite a bit. That means you're almost at the bottom. We are now at the door, knocking. 40. Why wait until 50? Yes. Had you purchased it a fortnight ago, wouldn't it have been more ideal? Of course. I begged you to buy it a few weeks ago, but if you weren't going to do it then, why not? Buying 40 instead of 50 seems like a waste. Making the jump from 40 to 50 is still just a 20% game though. Silver costs $40, so if you buy it at $50, you'll get 20%. However, 50 will not be the highest. It's far from the peak. Actually, I believe that 50 will replace 30 after we pass it. Silver will find support at 50. If you can find silver for less than $50, you're lucky. At the moment, it's a 1980s and 2011's double top. That opposition will eventually turn into backing, similar to how the $2,000 mark served as a barrier for gold from 2011 and 2024. That was opposition. Later on, it served as a foundation. Am I correct? The opposite of resistance is support in bull markets. As a result, we will break through that double top and silver will now trade at 50. So, go ahead and buy in while the price is low. Please tell me what is causing this. For what reasons are the prices of gold being the silver price movement is happening right now on this massive stage? And the reasons for it are the ones I've been explaining for years. Take a look at the actions taken by the Trump administration toward the Federal Reserve. So far, at least they've maintained the appearance of the Fed's independence. Now, I've already stated that this was completely false, that there was absolutely no autonomy, and that secretly they were cooperating closely. It seems Trump has abandoned all pretense. He has now made it crystal clear that the Federal Reserve is politically motivated. His own friends will be joining the Federal Reserve Board. Just so he can fire them and install his own buddies, he's coming up with dirt on them. Also, lowering interest rates is something he's after. For what reasons does he wish to lower interest rates? We are unable to afford the fees, he informs you. The US government, he argues, must cut spending. Our interest expense needs to be reduced. High mortgages, in his opinion, are too much for the housing market to manage. In order for home buying to become more affordable, interest rates must be lowered. Am I correct? Thus, at these interest rates, we are financially unable to continue. Exception being the current low interest rates. Basically, they aren't as low as they formerly were. We require those extremely low interest rates due to our substantial debt. Those ridiculously low loan rates, though, will do little to help our creditors. If interest rates drop, the lenders will no longer be willing to give us their money. I actually expect long-term interest rates to go up when Powell reduces rates. The Trump administration is going to be very furious about this because lowering long-term rates is the only reason for cutting short-term rates. Well, long-term rates rose when the Fed decreased short-term rates previously. One of the reasons they ceased cutting was to avoid further upward pressure on rates, which they saw as being excessively low, and further reductions will only lead to further inflation. If the rate cuts implemented by the Trump administration fail to rein in inflation, the Federal Reserve will revert to quantitative easing, which is expected to trigger a catastrophic inflationary wave. Once long-term interest rates rise as a result of the rate reduction, the Fed will have no choice but to begin purchasing these bonds, as no one else will be interested in them once they realize the game is a hoax. How can foreign lenders be interested in providing us with funds when inflation is on the rise and the dollar is losing value? Who might be interested in lending money to the United States government? The United States government is sending a message to all of the creditors that they could care less about them. By debasing the currency we pay you in, all we want to do is reduce the interest rates you pay us. Consequently, the reduced interest rates will discourage buyers of the treasuries. The Federal Reserve will be the sole purchaser, and increasing money printing will be the only means to achieve this goal of creating inflation. Not to mention that the dollar index fell back below 98 as the week came to a conclusion. Around 9,780, I believe it closed. Additionally, US Treasury yields went up during the week. Considering the 30-year Treasury yield of 4.92%, they didn't increase much. It's nearly at its highest point. In other words, it peaked at little over 5% right after the Liberation Day sell-off, just slightly more than 5%. As of late, the 10-year has made greater gains. The 10-year yield dropped from just over 4.5 to 4.23. However, as a result of markets pricing in increased inflation forecasts, the yield curve between the 10s and the 30s has widened. The economic evidence suggests the contrary. So once the Fed begins decreasing rates, those expectations will only grow. Here is what we received today. We recently learned about the trade deficit. What was it, I wonder? August figure, but it skyrocketed to 103.4 billion. The merchandise trade deficit for the month is, in my opinion, the second worst in history. During the COVID reopening days in 2022, I believe that was the only time it was worse. Remove that though. In spite of tariffs, the trade gap continues to rise. An increase in imports of around 6 or 7% was the primary factor. Less money was sent out. The trade deficits are actually widening, despite the tariffs imposed to narrow them. Government spending shortfalls are skyrocketing.